For joining. My name is Maggie Crowley. I am head of strategic development here, which is the team that manages so many of our CPA partnerships. And I am joined by Lucas Martin, who I think is probably a very familiar name to you guys. You've gotten emails from Lucas about this very event. And then we also have Ben Brissett from our consulting team, who is one of our tax experts. And I actually will let Ben tell us a little bit about himself and his background, because he is going to be your subject matter expert today.
Perfect. Thank you, guys. Thanks for having me today. Thank you, everyone, for joining. As Maggie said, my name is Ben Brissett. I've been with Leyton a little over 2 years now, working in a few different credits fields for us here, mainly the research and development and the employee retention tax credit. My background is in accounting. I have a bachelor's in accounting, a master's of business administration, and I'm currently going through the same CPA exam that you guys all had to sit through. So I'm experiencing your pain in real time now, but hope to, be a part of the CPA group, not too distant future. But I'm happy to be here. I'm happy to help with any questions, and then also be available following this call for any follow-up questions or future conversations if anything does arise from this.
Well, Ben, I know a place where you can get some CPE credits after you have your CPA cert.
Perfect.
Just come to us. I don't know if any of you on the phone joined our state and local tax webinar we hosted yesterday, but I think we're going to do another round of it. It got pretty good ratings, and people want more salt. So we're going to give the people what they want. So for today, this webinar, and the need and desire for it came out of the webinars that we do typically with CPA Academy and questions that we get in our interactions that we have with our partners. And these are some of the most frequently asked questions. So we wanted to get them answered for you. We always feel bad when we run out of time at the end of a webinar. And so it's a Q&A format. We would ask that if you do have a question that you'd like to have answered today, pop it in the chat. Lucas is going to be managing that. And if it's already in the presentation, then it will get answered. And if not, we will get that taken care of. That is the whole point of today, to answer your questions. So put them in the chat when you have it. And let's get right into it. We're going to start with the research and development tax credit set of questions. And then the second part will be for ERC. So question number one. Oh, I gotta minimize this box so I can actually read them. What expenses are eligible for the R&D tax credit? Ben, do you know?
I do. So there are 4 different cost categories that we can include in this calculation. The 4 cost categories are wages, contractor expenses, or any third-party companies, software expenses or web hosting, and then supplies. Supplies are typically anything consumable, so things that gets used and consumed over the course of the year. And for web hosting, we think about computer servers and web leasing. But those are the 4 different cost categories, and we can take portions of each of those expenses that relate to the various projects that we can identify for you guys.
I think the IRS has a really antiquated way of how they like denote what web hosting is. They say, like, what is it? They say like not computers, but
so it was created back in the 1980s when it used to be actually leased computers. So people didn't have computers at home, so you would go out and actually lease computers or lease computer time. So now they kind of transition it. They haven't changed the definition to really match today's times, but it kind of transitioned into that web hosting, the Amazon Web Services or Microsoft Azure type expenses. So it's computer leasing to some degree, but we always like to take a look into what software expenses that you guys or any clients that might have, so we can really examine the full scope of what could be available.
It makes sense. I think the IRS might need to update their verbiage. Question number 2. Do we need to be able to support the expenses related to the R&D tax credit with detail of how much time or money was spent on each project? Ben?
For this, we do to some degree. It doesn't have to be any time tracking or granular details into various different expenses. because the IRS does allow for a reasonable estimation on various different expense categories. For instance, one thing that we do is we could just look at a profit and loss, take a category from listed right in that profit and loss, and then take a estimated percentage of that. The IRS would ever come back and do an audit or look into it, we would want to make sure that we can, substantiate this information and substantiate the details, but it doesn't have to get down to the dollar amount, the granular, little details of everything. So there is some wiggle room there for estimations.
In our experience, most of the information that you need to substantiate it is documents that you have that a business would have readily available anyways.
Absolutely.
It shouldn't be like out of reach for someone to get supporting documentation.
Absolutely.
Now, Ben, what portion of these wages can be used?
So we're allowed 3 different levels of involvement. Someone who's directly engaged, the person who's directly performing the activities, but also 1 level above and 1 level below. So anyone who's supporting or supervising the ongoing efforts, we can, we can include a portion of their time and wages spent on those activities. So, could be a management position who's actually not even doing the R&D, but does some weekly meetings to, meet with the R&D team to know about what's going on, how things are progressing, and what are the next best steps. On the other side, we've actually been able to qualify time as far down as we worked with one lab before who the janitors came in and had to clean various different equipment and supplies. They would come in, clean that time. And essentially the way we looked at it is if the ongoing time and money spent on the projects is integral to that R&D, that janitor's time can be included as well. So anyone supporting, supervising, or engaged in the R&D to some capacity can be included.
That's so nice because it really can bulk up the qualified wages and increase that R&D credit, and it's completely allowed.
Absolutely.
Great. What criteria is used to determine if a company is eligible for the credit?
So the main thing, the IRS created a 4-part test. It's really the IRS's 4-part test is what they call it for R&D materials. Test number 1 is just a permitted purpose test, quite simply saying that you're doing this research for a reason. It's related to your business and something that's ongoing within your business. The second test is just saying that it's technological in nature. So it's rooted in the hard sciences, whether that be biology, engineering, chemistry, one of the hard sciences. Unfortunately, like things such as psychology or social work, haven't been able to qualify in the same regards, but something that's rooted in the hard sciences is the test number 2. And then 3 and 4 kind of go hand in hand. There's an elimination of uncertainty and a process of experimentation. So quite simply, you're uncertain about the outcome and you're going through a process to experiment what the best alternatives would be. And there are some, finer details in there and some more verbiage between the IRS regulations. And that's really our job, and our technical consultant's job is to decipher through the various different activities and projects that you guys might be working on to be able to qualify. But from a high level, it would just be those four tests need to be passed.
Oh, sorry, I forgot to show this. Screen. There you go.
No worries.
There is the really well-named 4-part test. So for an S Corp, does the tax credit pass through on the K-1?
It does for all pass-through entities. So for S Corps, for partnerships, it would pass through into the K-1 and the ultimate owner in their personal tax return. As the company doesn't pay the corporate income taxes in the same regards, the credit is going to flow through into the personal taxes and be able to be used to offset any income taxes related to the business on the personal tax side.
Great, thank you. And just a reminder for those of you who are listening and watching, please put your questions in the chat. We want to answer them and we will answer them. So what happens after the 5-year window that companies have for the R&D payroll tax credit?
Yeah, so the R&D credit, they have 2 different versions of it. They have the payroll tax credit and then the income tax credit. They are pretty much the same exact credit, at least as far as the calculation standpoint, where when we identify the expenses, we go through that 4-part test and we calculate the credit. The end credit is going to be the same on both the payroll and the income tax credit, but the IRS does allow for a payroll tax version for newly formed businesses or businesses that have just started generating revenue and doing some research. So with that, the IRS has a 5-year window for new entities that for their first 5 years in generating gross receipts and having these qualified research expenditures, they're actually allowed to offset payroll taxes on an ongoing basis rather than income taxes, mainly because these newer businesses, these startup businesses, typically don't have any income taxes that are owed. And so they want to make this credit still beneficial for those startup companies. However, after that 5-year window, you would just switch over to that income tax credit version. And if there's still no income taxes at that time, the credit can still be applied for, and then it would just be used as a carry forward to offset taxes in the future period. So our process, our examination is all going to be the same. It would just transfer from the payroll credit to the income tax credit after 5 years.
Nice. So it sounds like the R&D tax credit is a strategy that you can use from year one to infinity.
Absolutely.
Are funded costs also included, or only non-funded R&D expenses?
So this is one that we would request to look at your various different contracts. We have a team here that would go through those contracts and just ensure that we're reading them correctly and seeing that they truly are being funded, because typically funded work is not included in the credit. However, what we look for when it comes to contract review is 2 things. First, the company that's claiming the credit needs to ultimately be financially at risk, quite simply saying that if a project were to be extended or go over budget, that company is the one who would have to front the extra money and front that bill. And then secondly, we want to see that they retain substantial rights, whether that's rights to the IP that's being created or some rights within the contract. We would just want to read that contract and make sure that our verbiage is understood correctly, and that the funded costs have to be excluded, because on some situations it can be included and can add to the overall credit.
Ben, I've seen a lot of cases where a company thinks that their contract is a fixed fee contract, and then when we actually get into it and read through it, we identify that it's in fact time and materials.
Absolutely.
So I think a lot of them can be labeled incorrectly, or someone thinks they're doing something one way because maybe someone told them that in the business, but when you look into it, there is opportunity for them to benefit from the credit. So it's always worth having someone take a look and identify that.
Exactly. On that point, when it really just comes down to the little language or the hidden details of that contract, where sometimes it might be labeled as a fixed fee, but it's a fixed fee with a cap. Now that or time and materials with a cap, I should say. Let's say it's I'm paying, I hire Maggie and I'm paying her X amount per hour or X amount per day, but there's a cap on that. So while it does look like a time and materials at a sense, it still is fixed fee in some regard, as there's a fixed cap there. And so that can help create, we can help show and create some financial risk or financial liability. So it is certainly something that we want to look into all the language and the full contract to be able to review and ensure that nothing's being missed.
So if this is the first year the company is operating, do you use 0 as an average gross receipt when calculating the credit with traditional method, or do you have to use ASM?
So there are 2 different methods of calculating this. You have the traditional or otherwise not known as the regular credit, then also the alternative simplified credit or alternative simplified method. You can really do either calculation. The way we do it is we calculate it both ways, and whichever one is more beneficial and lucrative to the company is the one that we select and move forward with. There are some rules regarding lookbacks or amended returns needing to be consistent. So you're not able to switch back year after year for amended returns, but on a ongoing basis, you can switch to whichever one is more lucrative. It does typically turn out to be that for a startup business, for the first few years in existence, the traditional method is more beneficial. And that's really because the traditional method is based off of this fixed base percentage, and this fixed base percentage is locked in at 3% for the first 5 years of a business being in existence. After that, it is based on the comparison between gross receipts and research expenditures, and that percentage can vary. What happens with that percentage is it really relates to how much of the credit we're able to include in how much of the expenses we're able to include in the credit. So a higher fixed base percentage actually reduces the credit. So In this method, yes, you would show $0 on the average gross receipts line because there is nothing, and you'd have that average, you'd have that fixed base percentage of 3%. But we do look at it both ways and just really choose the most lucrative and most beneficial overall.
Makes sense. Will section 174 change the benefit of the R&D tax credit? This seems to be a pretty hot topic lately.
Yeah, so this is a big topic of conversation right now. This is a detailed kind of overview of this on this slide, so I apologize for the many words on here. But really, there are a lot of uncertainties with this right now. The IRS hasn't really issued too much notices or instructions on how it's going to be implemented and really what the regulations are going forward. So there are just some nationwide, industry-wide uncertainties still that we're waiting on answers. But as far as the credit standpoint, the credit itself isn't going to be impacted. The credit is still calculated based off of those same expenses. It's still used, either the regular credit or the alternative simplified method. So the credit itself is still going to be the same, and the credit still offsets dollar for dollar the amount of taxable income. However, the change really relates to the way the expenses are able to be reported. Typically, the expenses are able to be deducted in the year in which they were incurred. So you are able to deduct expenses that you are also going to be claiming a credit for. Now, with this 174 change starting January 1st of 2023, we actually have to amortize and capitalize those expenses over 5 years using a mid-year convention. So that just means in year one, we'd be allowed to amortize and capitalize 10% of the expenses. Years 2, 3, 4, and 5, we can do 20% each. And then finally in year 6, the remaining 10%. The changes in here now, because you're not able to deduct that full amount in year one, and you can only actually amortize and capitalize 10% of it, there's going to be an increase in taxable income, and which means there's going to be an increase in your taxable liability. But the credit itself is still going to be that same amount to decrease that taxable liability. What we're seeing through our analysis and our examples so far is that it's taking about 3 or 4 years before the benefit the benefit is fully received back. And then once you're in year 6 and you're able to amortize 6 years of expenses, it's just like the old days with the fully deducted in year 1, because it does. It will even out and compound year over year. So in year 6, you get 6 years of amortization and capitalization in that 1 year, 10% from 2 of the years and 20% from the other 4, which means you get 100% all in that 1 year. So it does take a little bit of time in order for it to recoup those losses at the beginning, but the credit itself, there is no impact. There is no change to the actual credit.
Nice. So that's the last question in the R&D section. Are there any questions that people would like to address about 174 before we move on to ERC questions? Are people able to unmute themselves if they want, Addie?
Yes, they are.
Oh, great. Well, if people want to unmute and ask the question, we can also do that. All right. Well, moving on, Ben, I guess you're.
Oh, I think we do have one hand up right now. Yep.
All right.
Yeah. Michael, you want to just go ahead and jump on in? You're still muted right now. I'm not sure.
Michael might need some instructions on how to unmute, Sarah. I don't know how to do it.
It should be in the bottom left corner of your screen. Yeah, it looks like you're unmuted now.
Hi, Michael.
We're not able to hear you on our side. It looks like your microphone's unmuted. I'm not sure if it's coming through though. If you want to type the question, if that's just an easier, quicker option, feel free to type it and we can address it that way.
Okay. Sorry about that, Michael. We'll email you too, or we can give you a call after the session if you're not able to type it in there. All right, now we're on to another hot topic, ERC, Employee Retention Credit. The firm I work for received PPP loans. Are we eligible to claim the ERC?
Yes. So originally back in 2020, when this was first created, they said that if you filed for the PPP loan, you couldn't also file for the employee retention credit. However, starting on January 1st, 2021, they amended that to allow anyone who received a PPP loan to also be eligible for the ERC. And that is for both 2020 and 2021. So yep, even if you've got the PPP loan, you are eligible to receive the ERC in both years. And Maggie, just quickly going to hop over to Michael's question. I saw it pop up in the chat. Yes, the 174 starts. So as of right now, it was created back in 2017, part of the Tax Cuts and Jobs Act. And then this was pushed off to begin starting for tax years 2022, beginning January 1st, 2023. It has been a topic of conversation around Congress because it has passed the first legislation in order to be repealed and pushed back to 2026. And now it's currently sitting, I believe it's with the Senate right now, trying to get it to pass that. But we're now like 22 days from the new year. So who knows how quickly they're going to move and if it's going to happen before the new year. But as it stands currently, yes, it's starting as of January 1st, 2023, those changes in amortization and deductions.
Thank you for answering that. What kind of documentation do you need for a government order?
So for a government shutdown, the first and foremost thing that we need to see is that the shutdown is rooted in a government order and government mandate. It does have to be, the company does have to be strictly restricted from business, a direct shutdown by a government order and mandate. Essentially, we wouldn't be able to show an indirect shutdown based off of, for instance, if a company's client was shut down due to government order, we would look at that more of as an indirect shutdown. But we do have to just see a government order, a government mandate that specifically restricts the company filing for the employee retention credit that is required to be shut down. From there, we'd really also just look into any requests, any written documentations, any email correspondence internally explaining, various different shutdowns, changes to business, time restrictions or limitations. But for this, there is no end all be all or specific documents that we look for. It's kind of a conversation that we have, and then whatever they're able to provide for us, we look into and see if we can match it to the mandates and match it to a time frame. So kind of just depends on what's available, and really anything would work that shows that a shutdown was endured.
Will the loan payments paid under the CARES Act on an SBA loan in 2020 and 2021 be included in gross receipts?
So for this, typically no, loans aren't included. Loans that since loans need to be paid back, they're not included in gross receipts. However, grants are included in gross receipts. The IRS does specify the restaurant revitalization and the shuttered venue operators grants as two grants that aren't included in gross receipts. So if anyone received those two grants, we wouldn't include them, and the same for loans. But anything aside from those two for grants, we would have to include as portion of gross receipts.
Alrighty. What if a company wasn't in business in 2019?
Yeah, so one of the rules for ERC is for the decline in gross receipts. What you do is you compare quarterly profit and losses of 2020 and 2021 to the same calendar quarter in 2019. If a company wasn't in existence in 2019, there's two different paths that they could go down, really three different paths. For starters, if they had any shutdown in 2020 or 2021, regardless of when they started business, they can always go down the government shutdown path. You're also able to look at the decline in gross receipts, and we would just use the earliest quarter in which the business was incorporated. So let's say they were incorporated in Q1 of 2020. We would compare every quarter of 2020 to quarter one of 2020, as well as the first quarter of 2021 to quarter one 2020. From there, once you have a full year of gross receipts, you would do a year over year analysis. So Q2 of 2021 compared to Q2 of 2020, Q3 of 21 to Q3 of 2020, and so on. And on top of that, There is also a recovery startup path. Now, this is specifically for businesses that were incorporated on or after February 15th, 2020. What this means is that regardless of if you had a decline in gross receipts or endured a government mandated shutdown, if your business was incorporated on or after February 15th, 2020, you automatically qualify for the third and fourth quarters of 2021. There is a cap on that, which means it's a max of $50,000 for each quarter. So $100,000 max for the recovery startup method. But that way, you don't have to show any decline. You don't have to show any government shutdown. You're automatically eligible for 2 quarters of 2021 already.
Right. If you don't pass the gross profit eligibility, but you were shut down during a quarter, is the credit only available for the quarter of shutdown or the full year of 2020?
So eligibility is determined on a quarterly basis. We do look at, like I said, with declining gross receipts, a quarter on quarter compared to the same calendar quarter in 2021. There is a bonus quarter. Essentially, we call it a bonus quarter. It's based off of 2 different notices within IRS legislation related to ERC that allow for the following quarters to qualify based off of a previous quarter's declining gross receipts. But for quarterly, for declining gross receipts, it is just a quarterly on quarterly qualification. However, for a government shutdown, we look at the exact period in which they were shut down. So it might not even be the entire quarter. It could just be a couple of weeks, or it could be the entire year. However, it's whatever's specifically mandated within that government mandate is the time frame that we can use. So it's not going to exactly line up quarterly over quarter like the declining gross receipts would.
Okay. Do taxpayers have to amend their 2021 tax returns for ERC income received in 2022, or can they deduct it on their 2022 return?
So this is one unfortunate side. It does require an amendment income tax return for any company that filed and received employee retention credit. The way the IRS looks at it is in order to avoid a double benefit, double dipping essentially, they don't want you to be able to receive credit for wages while also being able to deduct those expenses and those wages in the same year. So if wages were used in 2020 to calculate an employee retention credit, you would need to amend the income tax return for that year in order to reduce the deductions for wages. In other words, they're essentially taxing this amount. So it's going to increase your taxable income by the amount of the credit received. And it's their way of treating this as taxable income and receiving some money for filing out or giving out credits to all these companies.
Okay. Does it matter if the employee is no longer with you?
No, not at all. The calculation and qualification is merely based off of the wages that were paid in those time periods. So the employee doesn't have to be here any longer. There really doesn't have to be any employees or any activity still going on within the business. As long as those wages were paid and endured during that quarter or during that period in which we're qualifying, those wages are allowed to still be used in the credit and used to calculate and identify any available credit for them.
All righty. Do you file ERC with your payroll provider or just complete the 941X in paper form and send in? Are there pros, cons to either method?
So you could do either or. The 941X is a fairly simple form to complete in regards to the employee retention credit. Outside of that, it can get very complex and very difficult, but the ERC really just relates to 3 or 4 lines within that 941X. So you certainly can complete it yourself and then just mail it in. It does have to be mailed in and through paper form, so it does have to be completed by hand and then mailed into depending on which state the company exists in. It's different IRS locations that it would get mailed to. But typically, what we recommend and what we say is to have the payroll provider or accountant complete it for you guys. And that's just mainly because the payroll provider is going to have that inside knowledge of the actual payroll, what was filed originally in that original 941. they'll also be able to make any adjustments within the specific employees' accounts and be able to go through and just make sure that everything's that's fine-tuned. And at the end of the year, when you run a payroll report, you can see exactly how much money was spent based off of ERC wages or how much was actually paid out of pocket, and just the relation between the two. So it can be done by yourself. We would just recommend the payroll provider to do so, or you could also just use an outside accountant, your CPA, or if you're working with us, we do have a partner as well that can help you file it for you. But typically, we do recommend some outside help, whether it be your payroll provider or another accountant.
And that's all we got for you guys. Can we, we'd love to open the floor to any other questions that you guys might have. We have a hand up, but I don't know if that's just an old one from Michael, or maybe Michael Boyle. Oh, now it's down. Okay, Michael Boyle left. Okay. Well, please pop your unmute or pop your questions in the chat box. I'll put on some music while we wait, just in case.
And we have a question in the chat from Larry
All
Templin.
right. All right,
The
Larry.
question is, when are the due dates to file for ERC?
So it is all due dates for them. Typically, you get a 3-year window from when the 941 was filed. However, they made an exception that now for 941 X's, they can be filed 3 years from the date which that tax return was filed. So typically, it's going to be the deadline is going to be April 15th of 2024 for any ERC for 2020, and then for 2021 it'll be for in April 15th of 2025. So we still have, we're almost into 2023 now. We still have over a year before we start hitting any type of deadlines. But April of 2024 would have been when deadlines begin coming up, and the credits no longer being able to be applied for.
Thank you.
Thank you, Larry, for the question. And we have another, guys, from Cindy Abercrombie. Question is, how do you make the JE if you receive ERC in 2022 for 2020 wages?
So as far as the journal entry, it does kind of depend company on company. In 2022, the way the IRS wants to see it as far as on the taxable income and income tax side is they just want to make sure that those deductions are being reduced. As far as how that journal entry is really created, it can just kind of depend, or it can vary from company to company. The end result, they just want to make sure that the wage deduction on your page 1 of that income tax return, they just want to make sure it's reduced by the amount of the ERC credit. So how the journal entry is created can vary, as long as the end result just shows that the wage deduction is reduced.
Well, excellent. Thank you, guys. I think that about wraps it up.